Next is Ms. Julia Leung, the Deputy CEO of the SFC, who will also come up and provide us with her next keynote address. Thank you, Julia.
Good morning. Thank you. Thanks for the invitation to deliver the keynote address for AIMA APAC Annual Forum 2022. This event was originally scheduled for March this year, and then it was rescheduled to June, and it's now to September. I'm sure it's worth the wait. Yet, a series we've already overtaken by a severe wave of COVID in March, and we are getting over it. Yet, the series of local and global challenges on multiple fronts over the past few years, Hong Kong's position as a leading international financial center connected to the mainland has grown in importance. We have seen robust growth in Hong Kong's asset management center. Today, I want to survey the hedge fund landscape as observed from the data collected by the SFC and speak about some recent policy developments as they relate to market resilience, virtual assets, and sustainable finance. Last year, in conjunction with an initiative of IOSCO to collect data on investment funds, the SFC conducted a survey of licensed hedge fund managers in Hong Kong. I would like to take the opportunity to thank you, all of you, for participating in the survey. We note from AIMA's recent publication, Alternatives in Hong Kong, which is on your desk, that the Asia-Pacific's alternative asset class is growing faster than anywhere else in the world, and Hong Kong is the largest hedge fund center in the region. This growth is also evident from our recent survey data. Between 2018 and 2020, the number of hedge funds increased by roughly 20% to more than 1,400. During this time, the total assets under management, the AUM, managed by hedge funds, surged by around 48% to US $287 billion. Nearly 90% of the survey respondents reported Hong Kong as their headquarters, and the total AUM was 70% of the total hedge fund sector AUM as at the end of 2020. This is in sharp contrast with the situation over a decade ago, when our survey found that the managers with the largest AUMs were mainly global firms based overseas. So the headquarters is clearly here for the hedge fund sector, which is the fastest growing. In terms of hedge fund strategy, while the equity long short has remained dominant in the local landscape over the years, an increasing number of large fund managers are now running credit or multi-strategies. Consistent with the trend identified by AIMA, we see increased diversity in our hedge fund sector, with a variety of equity and credit-related strategies gaining traction. The financial data reported to us also reflects a very solid sector growth. For the asset management industry overall, total income has grown significantly, over 50% over the past 2 years. Hedge fund net managers regularly make up around 20% of the sectors, that's the entire asset management sector's total income. This is evidence in the hedge fund sector it is evidence that the hedge fund sector is both diverse and strong, and is now a core pillar of Hong Kong's asset management industry. It helps foster the development of a dynamic capital market and support Hong Kong's position as a premier wealth management center and risk management center in the region. Next, I move to resilience. The COVID-19 pandemic puts the global financial system to its greatest test since the G20 reforms were put in place following the 2008 global financial crisis. Thankfully, the global financial system weathered the pandemic as a result of its greater resilience together with the effective policy responses. However, the March 2020 market turmoil also highlighted vulnerabilities in several segments of the market and reminded the global community of the importance of enhancing market resilience, in particular the non-bank financial intermediation. The dangerous combination of leverage and concentration was highlighted in the DECO incident a year later. This was a case when a hedge fund took an outsized concentrated bets that went the wrong way, leaving a trail of losses among prime brokers that had lent to the fund to build up its position. Discussions subsequent to the DECO incident have focused on enhancing the transparency of hedge fund positions and the ability of regulators to detect concentration risks in our markets. Since the 1997 and 98 Asian financial crisis, the SFC has enhanced our market surveillance tools to specifically monitor the buildup of large and concentrated positions in the market. Our monitoring toolbox was greatly expanded with the implementation of the mandatory reporting of the OTC derivatives starting in 2015. The use of trade repositories has given us a line of sight into the buildup of exposures and concentration risk in the OTC market. Our toolkit has been purposefully retooled to capture OTC equity derivatives data in a more granular manner. That is, at the holders level, the prime broker level, and the underlying security level, to spot outliers and potentially take precautionary action. I must emphasize that this is not additional reporting requirement, but they are using existing data more smartly. So far, our observation is that the aggregate exposures and risk positions taken by market participants have been stable and diversified. Our hedge fund survey indicates that the aggregate gross leverage used by qualifying hedge funds in Hong Kong was 7.9, a level below the global average of 12.4 at the end of 2020. Of course, averages could be misleading. We will remain vigilant and follow up on any alerts, whether on or off market, to ensure that our financial market is resilient in times of volatility. An important competitive edge Hong Kong has as a hedge fund center is its role as a gateway to China. This is reinforced in our ongoing journey of expanding mutual market access with the mainland and developing corresponding risk management tools for hedging mainland assets. The Financial Secretary have already talked about the three initiatives, and just last week, one of the most exciting ones would be CSRC's announced the foreign companies primarily listed in Hong Kong would be included in Stock Connect. Over the past few years, you have witnessed the success of Stock Connect and Bond Connect. The growing size of exposure to A-share equities and mainland bonds have spurred a significant demand for risk management tools. The launch of MSCI China A50 Connect Index Futures last October has provided a simple but useful tool for investors to manage their A-share exposures in Hong Kong. In recent months, the contract's average daily turnover exceeded $1.1 billion, and its notional open interest averaged around $1.6 billion. In just 11 months, this new contract accounts for about 20% of all offshore A-share futures trading. This has undoubtedly been an instant success. Also, CSRC announced the support for Hong Kong to study the introduction of Treasury bond futures, which FS also mentioned. This followed on our July announcement of Swap Connect, which marked another milestone in mainland Hong Kong mutual market access. Global investors will be able to access the mainland interbank derivatives market from Hong Kong. Swap Connect and offshore Treasury bond futures will both provide efficient ways for global investors to manage interest rate risks arising from their mainland bond investments. And this will enable them to participate more broadly in the vast mainland bond market. All of these new hedging tools will encourage long-term investments in Hong Kong by providing global investors with an additional liquidity pool for managing their risk exposure to mainland markets, particularly to ease sell-off pressures amid market volatility. This enhanced ecosystem will attract new capital, promote stable market development, and further anchor Hong Kong's position as a leading risk management center. Another takeaway from SFC's hedge fund survey in 2020 suggested that virtual asset investment was a minority spot, but that might be changing. AIMA's global survey conducted in the first quarter of this year found that among 89 respondents, 1 in 3 traditional hedge funds was investing in virtual assets, with a further 30% looking to invest in such assets, compared to only 1 in 5 hedge funds investing in virtual digital assets a year earlier. It has become clear that with an increasing number of institutional participants, virtual assets are entering the mainstream of our financial system. But this largely unregulated sector still has a long way to go before it can be considered mainstream. One just have to look at recent events. The collapse of Luna and Terra, along with the slumping cryptocurrency prices, led to the default of crypto hedge fund 3 Arrows Capital, which, like Archegos, had amassed big bets turbocharged by leverage. The demise of 3 Arrows Capital brought some of the largest crypto lenders to their knees, shining a spotlight on how fast and wide risk can be transmitted to other parts of the crypto ecosystem. History just repeats itself. Remember the fall of long-term capital management in 1998. In response to the recent turmoil, many jurisdictions have tightened or are planning to tighten the regulation of virtual asset activities. The Financial Stability Board has highlighted the importance of addressing the potential financial stability risk posed by crypto assets. It noted in just July of this year that an effective regulatory framework must ensure that crypto asset activities posing risks similar to traditional financial activities are subject to the same regulatory outcomes. The SFC has been a strong advocate of same business, same risk, same rules. In fact, we have been in the forefront since we formulated an opt-in approach to regulate virtual asset trading platforms in 2018. The Anti-Money Laundering Amendment Bill, which has just been introduced to the Legislative Council, would make licensing by the SFC mandatory for any entity operating a centralized virtual asset exchange in Hong Kong or targeting Hong Kong investors. As an illustration of our regulatory approach, not only anti-money laundering, but also market integrity, cybersecurity, safe custody of assets, and operators of conflict of interest will be regulated in a similar manner as regulated entities providing brokerage or automated trading services. Cognizant of the fact that virtual asset investment is here to stay, the SFC issued a joint circular with the Hong Kong Monetary Authority in January of this year to provide guidance to traditional financial institutions, that is banks and brokers, that engage in virtual asset-related activities. The circular covers product distribution, dealing services under omnibus account arrangements, and advisory services, mainly to professional investors. Besides approving licensed fund managers to manage virtual assets funds, we have already approved the first broker to conduct agency dealing in virtual assets via the SFC license VATP. A licensed broker also recently conducted a private security token offering to distribute security tokens to professional investors in Hong Kong. Globally, as other regulators are formulating newer and tougher regulation, the SFC has consistently applied a risk-based and same business, same risk, same rules approach. The predictability and clarity of our current framework will provide a solid foundation for virtual asset service providers to establish locally and for traditional financial institutions to interface with these providers to offer a diversity of virtual asset products to clients. It is now clear that the sooner the crypto industry embraces regulation, the faster it can become part of the mainstream finance. Next, I will move on to a subject of growing importance in asset management space, sustainable finance. Alternative asset managers have been at the forefront of tackling climate change. Your institutional clients, such as pension funds and sovereign funds, have a better understanding of their role in financing a transition to a low-carbon economy. As the financial regulator, the SFC was among the first in the region to adopt a mandatory approach to require fund managers to incorporate climate-related risks in their investment decisions, risk management, and related disclosures. After extensive consultation with asset management industry, including with AIMA multiple times, the SFC amended our fund manager code of conduct to provide guidance in this regard. This established our ESG leadership as an asset management hub. And just last month, the first phase of the new regulatory requirements came into effect, with the quantitative disclosure expected in mid-2023. The demand for reliable ESG ratings and data products are constantly growing. We share the industry's concern about low correlation and comparability among ratings and products provided by different ESG service providers. Without adequate transparency from the providers about the approaches and methodologies they use, the quality of risk assessment performed by fund managers may be called into question. As a next step, we are reviewing fund managers' use of ESG ratings and data product providers, beginning with a fact-finding exercise to understand the business operating models of these ESG service providers, as well as current market practices of fund managers when selecting and engaging these providers. The study will help us prepare guidance for the asset management industry on using ESG service providers. Further, we note the concerns expressed by AIMA and some other industry participants about the lack of green finance talents in Hong Kong, as well as the limitations of available data. The SFC and members of the Green and Sustainable Finance Cross-Agency Steering Group are working on different initiatives, including data and capacity building to address these concerns. The last point on capacity building brings me back to AIMA's report on Hong Kong, which identified developing, attracting, and retaining high-quality international talent as one of the 6 pillars that were crucial to Hong Kong's success. I could not agree more. Unquestionably, Hong Kong is now facing some big challenges, which are mainly pandemic-induced. In his opening remark, Jack has mentioned a lot of expectations from what the Financial Secretary may say or I may say on this topic. Financial Secretary is still here. In my interaction with him and many of the senior officials of our government, I have no doubt that Paul and the others are acutely aware of the importance of talent retention in the financial sector and is working tirelessly to address your concern. And these include hotel quarantine time for inbound travelers. With the roadmap and direction of travel much, much clearer now than before, let's have faith and work together to build Hong Kong into an even bigger and stronger private fund center. Thank you.